Hello everyone. Good morning, good afternoon, good evening, depending upon when you are watching this video lecture. In the previous classes, we discussed about the concept of demand, the meaning of demand, what are the determinants of demand, different factors that will influence the demand function, and the law of demand, the core aspect of this entire chapter, or we can call it as theory of demand, and how the demand schedule or demand curve will be there at an individual level and even at a market level. And what is the rationale behind the law of demand? Why the law of demand works? What are the exceptions to the law of demand? In what cases the law of demand will not work? And what is the difference between expansion and contraction of demand? Increase or decrease in demand? Very important aspect. Same thing expressed in a different way. Movements along the demand curve versus shift of the demand curve. How that happens? In what situations we can call that quantity demanded? In what situations we can use the word demand? That also we discussed. Then the more computational technical aspect of elasticity of demand, particularly the price elasticity of demand. We have discussed the concept of that, how to calculate that using different methods, just by directly using the formula, or by using the point elasticity method, or by using arc elasticity method, how to compute the price elasticity of demand we have seen. And most importantly, not only just the computation, how to interpret the various values that the price elasticity of demand of a product depict. So that also we have observed. Very important aspects in this chapter. The core aspects of this chapter, once again, will be related to the price elasticity of demand. That is one of the types of elasticities of demand. How to calculate that we have seen by using different methods, including total outlay method or expenditure method or total revenue method. And what once again makes the price elasticity of demand high or low? What are the determinants of the price elasticity of demand? That also we have discussed. What different factors will influence the price elasticity of demand related to a product? We discussed about them. So I hope all of you are reading them, understanding them, and you are able to apply if need comes in the form of answering certain questions, which we will see later. As of now, each and every concept has to be clearly understood. For that, reading and even listening to the correct explanation, if at all possible, writing some key points also will help. But that's not like compulsory, but that can be cultivated as a good habit. Anyway, after the price elasticity of demand, now let us continue our discussion related to the income elasticity of demand. Income elasticity, for that matter, any elasticity is basically nothing but the quantification of responsiveness of the demand in relation to a change in X factor, whatever that factor may be. If that factor was price, we called it price elasticity of demand. If that factor is income, we call that income elasticity of demand. Now what we can call income elasticity of demand? That is the degree of responsiveness of the quantity demanded of a good to changes in what? Changes in the income of the consumers. So this formula also is more or less the same. Earlier, what was the formula? Percentage change in quantity demanded divided by percentage change in price. Now just change it a little bit. Percentage change in demand. Once again, you have to remember these words very clearly. When we use price versus demand, rather than using the word demand, we use the word quantity demanded. Actually, the meaning is same. Demand also is quantity demanded is also same, but that is the usage. So when price versus demand is there, that will be used, the word used is quantity demanded. When something else versus demand is there, then the word used is demand. So percentage change in demand divided by percentage change in income. Income is some other factor, not price. So if there is a change in the income of the consumers, then how that change will impact the demand is what income elasticity of demand will tell us. And if it is high, that means a particular product is more responsive to the income of the consumers. If it is low, that means the product is less responsive to the income of consumers. So that is how it has to be calculated. Once again, if at all we need a formula for that, this can be considered as the formula for it ultimately, finally. So delta Q divided by delta Y. So delta Q means change in the quantity, only change in the quantity, divided by delta Y means change in the income, multiplied with Y means original income, Q means original quantity. So same like price elasticity of demand, the formula is not different. Instead of price, what is there here? Y is there. There it was P, here it is Y. That's the only change. So what is P there? It was price. What is Y here? It is income. The concept is same, formula is same. What does it indicate is same. The only thing is which factor is influencing demand, that is changed. Earlier it was price, now it is income. So this is the formula you can use. Change in quantity divided by change in income multiplied with original income divided by original quantity. So what is the EI here? That is the income elasticity of demand. These denotions are important to be noted. That's what we are just calling it as income elasticity of demand. This elasticity EI is income. EP means price elasticity, like that. These are only just indicators. Don't worry about them. Understand what they mean. That matters more than what is the way it is depicted. What is the way it is just shown. You use A, B, C, X, Y, Z, P, Q, or whatever names you want to do. You can use them. Ultimately, that does not matter. What matters is the substance over form always. Substance matters. So what does each of these letters indicate? That matters. So keep this in mind. This is a normal thing always to be kept in mind. Substance over is always greater than form, right? So form is what here we are using these words. Form is just the way they look. We are using the word EI. EI is the form. It's okay. That's also okay. We use it. But important thing is this. That is income elasticity of demand. We are calling it as EI. No, sir, I will call it IE. Okay. I will call it DI. Okay. No problem. You call it anything. So nobody cares about that form. What is important, as long as you know that it is depicting income elasticity of demand, anything is okay. So that's what matters. Substance. These are the things which matter. So what each of these things is denoted by, that should be understood. So income elasticity of demand is equal to delta Q means change in the demand. Q is quantity, that is, so change in the demand. Q means original demand. So this is change in demand, that is delta Q. This is original demand, that is Q. Same way, Y means original income. Delta Y means change in the income. So money income, that is called income, that is called. So there will be always a little difference between income and money income. That's okay. We don't need to worry about that macroeconomic stuff. But yes, there will be definitely difference between a general income and money income also. Income is generally what? That is what is earned by a person. Another important aspect, but at a only conceptual level, not that we are going to use it. Income is a word used from accrual basis, whatever is earned by a person. Imagine there is a salaried employee who is earning some income by working in a company. So he will tell that this is my salary, this is what I am earning from the company. That is earning. Is he receiving everything? No. Usually, whatever a normal employee receives will be after what they popularly called as or cuttings. After so many cuttings, what they will receive is only some amount. If somebody is having a earning, that is income of say 15,000 rupees, cuttings of 2,000 rupees if they are cut, like contribution to ESI, PF, like that. Many cuttings can be there for employees. If that is cut and 13,000 rupees is given to the employee, so what can we call as money income of the person? 13,000 only, but not 15,000. So income is definitely different. Money income is different. So that difference is simply there. So money income is nothing but the received income, not the earned income. So this is an example, by the way. Don't try to form an equation now. Income is equal to earnings minus cuttings. There is nothing called cuttings. That is a usage word, colloquial word, which is normally used in the real life, not a technical thing. For understanding purposes, this is an example. So earnings are different, receipts are different. That we should know. Which is the one we are bothered about here? Is it earnings or receipts? Answer is receipts. And what is the way it is expressed? It is called, that is why, money income. Earnings is something that is generally called as income. Money income is nothing but receipts. That's it. That is about Y. What delta Y means change in the money income. So once we have these four things, you can find out the income elasticity of demand. Income elasticity of demand is calculated by using that formula, right? Then also always again the same point comes. So percentage change in demand is more than percentage change in income. So if then what happens? If numerator is bigger than denominator, then what happens? Naturally, the income elasticity of demand will be more than 1. If both are equal, then it will be equal to 1. Both are means numerator and denominator both are equal. Then it will be equal to 1. Then if it is numerator less than denominator, then it is less than 1. So simple thing. When the numerator is bigger than denominator, always, whenever there is a fraction numerator denominator, it will be greater than 1. It means the income elasticity of demand. When it is numerator and denominator same, then it is equal to 1. When the numerator is less than the denominator, then the resultant will be less than 1. This does not apply to only this. Any numerator denominator, the relationship is same. So nothing that we are freshly inventing here. It is a basic arithmetical relationship between numerator and denominator. If numerator and denominator are related like this, accordingly the resultant also will change. That's what is mentioned here. If the proportion of income spent on the goods remains the same as the income increases. So the income increases, but how much percentage of income increases, how much percentage of spending has increased or demand has increased. If both are same, then that income elasticity of that goods is equal to 1. Then we can say that is unitary income elasticity. What if the proportion of the income spent on the goods increases? As income increases, then what happens? So that means the income elasticity of that particular commodity is greater than 1. Means what? Total of income, that is demand that is changing, percentage of change in demand is more than the percentage of change in income. So the proportion of the income spent on the good increases as income also increases. So when both are in the same direction and the proportion of the income spent on the goods is increasing as and when the income is increasing, in that case income elasticity is considered as greater than 1. What if the proportion of the income spent on the good decreases? Here it was increasing as the income increasing. Here it is decreasing as the income is increasing. In that case, we can say the income elasticity is less than 1. That is exactly the 3 possibilities we have. If percentage change in demand is more than the percentage change in income, then the income elasticity is greater than 1. If both are same, then the income elasticity is equal to 1. If the percentage change in demand is less than the percentage change in income, then it is income elasticity of less than 1. These are the 3 possibilities that we can identify. So various things are there here to note. What if the income changes, how the demand of that particular commodity behaves? That's what is expressed by income elasticity of demand. Okay. Sometimes the income elasticity of demand could be 0. If at all the income elasticity of demand is 0, what does it mean? It means this product is completely unresponsive to the changes in the income of the people. For example, salt, once again. That product will have income elasticity of 0. Just because people's income has increased, people will not consume more salt. It will not have any impact on income of the people, will not have any impact on the quantity demanded of salt. Which means the income elasticity of that particular product is almost 0. Nothing, there will be any response to the demand of that product in relation to any change in the income of the people. In that case, the income elasticity of such products can be called as 0. If it is greater than 0, definitely there is a relationship between income and demand. If it is 0, means there is no relationship between income and demand at all. That type of products also will be there. But in general, many products will have a direct relationship with income and demand. So income increases, demand also increases. Income decreases, demand also decreases. Most of the goods will have the same kind of characteristics. So how the income and the demand of the goods are related for most of the goods. For some of the goods, they are not at all related. For most of the goods, they are related directly. If they are not related, then income elasticity of such commodity is called as 0. If they are related, and if they are related in direct way, in the sense both are increasing or both are decreasing, then those are normal goods. So simply speaking, for all the normal goods, income elasticity is positive. So this is the point we should note here. For all the normal goods, the income elasticity is positive. Positive. That is the essence of this discussion. For all the goods, the income elasticity is positive. Normal goods, those are all. For zero income elasticity, that means there is no relationship between income and demand at all. Of course, positive means it's just greater than zero, but it could be anything. It could be greater than zero, but still less than one, or it could be more than one also. So it depends upon the degree of responsiveness. That might change. However, definitely the income elasticity is positive for many goods. Those are normal goods. Now there are another category of goods, other kind of goods where there is a negative income elasticity, and those are generally inferior goods. This is a special situation. Means we can call this as exception. Normally, the demand and income of the people are directly related with each other. In case of inferior goods, it is exception. So if the income of the persons increases, what happens to the demand for inferior goods? That decreases, because the people have more income now. They will shift away from the inferior goods consumption to something else. For example, generally these are the examples taken. No need to change them. So Bhadra, Jawar type of grains, usually people will consume lesser as their income increases, because as their income increases, they shift from this Bajra to wheat or rice, which they think is a superior good, to Bajra. So when the people's incomes increase, they shift to other goods, other superior substitutes. That's what happens in case of inferior goods. So in case of inferior goods, what happens here is the income elasticity of demand for inferior goods is negative. That's it. Income elasticity of demand for inferior goods is negative. Means if one increasing, other one is decreasing. Income elasticity of demand for normal goods is positive, but it is greater than zero. Positive, but how much it is, we don't know. That can change from nature of commodity to another commodity. That's it. That is the normal goods. Second one is inferior goods. Another type of situation could also be there, possibly, where the income elasticity of demand is equal to 1. That is also possible. In other words, the percentage of increase in the income of the people is equal to the percentage of change in demand. Very rare, though, it is also another possibility. There we can call that as elasticity is unity. So either it is 0, or it is negative, or it is positive, or it is equal to 1. Okay. So that's what happens in case of unity. However, if the income elasticity of the goods is greater than 1, means there is a strong relationship between the income and the commodities, or the demand for such kind of commodities. So if at all it is greater than 1, such goods generally will be consumed only once the consumers become richer. So those are all luxury goods. So on one side, luxury goods will have a definite income elasticity of greater than 1. Not just positive, not just greater than 0, but less than 1. They will be more than 1 also. So luxury goods will have a greater than 1 income elasticity. Inferior goods will have less than 0 income elasticity. That is negative. Normal goods will have generally somewhere more than 0, but less than 1, or maybe more than 1 also sometimes. Mostly more than 0, but less than 1. That is normal goods. However, certain goods will not have any response at all. Those are called 0 income elasticity. And certain goods may exactly respond in the same proportion as the income increases. Those are called unitary elasticity. These are the possibilities of income elasticity of demand. And this example will tell us exactly how these goods are behaving. It's a very simple example. You can easily identify that. One by one, easily you can see that. So income of the household rises by 10%. Income increases by 10%. Demand for wheat rises by 5%. So income increased by 10%, demand increased by 5%. What is in the numerator, you have to keep in mind always. Don't put always the bigger number in the numerator. That's what some students do. Wrong. Formula you have to remember. Percentage change in demand divided by percentage change in income. What is percentage change in demand? 5%. Percentage change in income, 10. So 5 divided by 10, which means 0.5. So 0.5 is the income elasticity of demand for this particular commodity, wheat. So what is the kind of goods is this? It is a normal good. Normal good, how that will behave? income elasticity of demand will be more than 0. It is positive. It's not negative. It is positive, but not more than 1. That is normal good, we can say generally. Second category, income increases by 10%, but the demand increases by 20%. So demand in the numerator, 20 divided by 10. So 2 this is. So 2, 1 means what? Definitely it is more than 1. So when the income elasticity of demand is more than 1, usually we call that as a luxury commodity. Again, you don't say that TV is not a luxury, everybody has it. Those are all different things. We are talking basically the theoretical aspects. So what kind of commodity we are talking? We are not telling that people don't have TVs and all. So what kind of commodity it is? Is it a normal good? Definitely not. So what is the nature of this normal good? Understand and focus on that. Normal good is that kind of commodity where the income elasticity will be greater than 0, but less than 1. That is the nature of normal goods. Luxury goods, namesake. In this case of TV, you can say product X, product Y, whatever it is. We call it luxury commodity. In this case, usually the income elasticity will be greater than 1. That is positive, of course, but more than 1 also. This is positive, but less than 1. So these two are positive, but one is less than 1, one is more than 1. Then the third case, income of a household increases by 5%. And look at this, demand for Bajra falls by 2%. Falls. Here you have to look at the direction also. This rises, this falls. Earlier both are rising, no problem. So this is also rising, this is also rising. So, but how much it is rising, that was different. Now the direction itself is opposite. Income increases by 5%, Bajra demand falls by 2%. So the opposite direction is happening. So what is the increase in demand here? Minus 2% divided by 5%. So it is minus 0.4. Answer is minus 0.4. That is the price elasticity of demand. So for the inferior goods, what is going to be the feature here? Income elasticity is going to be less than 0. That's what is negative, right? When you say negative, that means it is less than 0. That means it is an inferior commodity. It's an inferior commodity. For them, Bajra is an inferior commodity. Example, that is, don't again take. Bajra is very healthy. I know that. We are not dietitians here. So we are talking about the general tendency of the commodities. As an example, it is an inferior commodity. Why is that? How do we say that it is inferior commodity? This is the technical reason. If this happens, if the income of the households increase, demand for such commodity falls. If that is the opposite direction, that means the income elasticity of demand is less than 0, which is negative. Then we can call that commodity as inferior commodity. So normal good, luxurious commodity, inferior commodity. These are the 3 categories generally will be common in practice also. In reality, we can observe them. How to observe them? Not according to our judgments. I think wheat is a luxury commodity. I think TV is a normal commodity. I think Bajra is a luxury commodity. I think doesn't matter. What matters is the numbers. What matters? How is it behaving? We don't care about these things. These names are just examples. We care about these things. These are the numbers we are bothered about. This is subject. This is just examples. So we have to be always keeping this in mind, not this. So that is where sometimes people do mistake, focusing more on these things. Bajra, what is Bajra? Let us say, I know some of you don't know what is Bajra. Actually, I don't know what is Bajra earlier when I first saw that. So I don't care actually, because what is Bajra? The some commodity, X commodity, Y commodity. Why should I care? Okay, if I have too much of enthusiasm to know, I will Google it. What is Bajra? Oh, okay, this is something which is a eatable. Okay, fine. That is Bajra. So what is Bajra is just a name. I know it, I don't know it also, doesn't matter. So what I know, what I should know is, okay sir, there is something called Bajra. It's a eatable. Okay, it's a grain, food grain. And what is the nature of that? When the income of the people is increasing, people are not eating that, people are reducing the consumption of that. Demand is for that is falling. So what I am interested in is, okay, that means that income elasticity of this commodity is less than 0, which is negative. Okay, that means that I can call this commodity as an inferior commodity. That is what is a technical thing that I am interested in. So instead of Bajra, I will put some other name. It doesn't matter. I call it Jowar, something else, some other commodity, some other things. And hundreds of names can be given. So the point is, here you don't worry about them. This can be just X, Y, Z, PQR, whatever these could be, nature of them, technically how they are behaving, that matters. These are just examples. Okay, keep that in mind. Don't once again go with the labels. What you should be focusing on? Substance, not on the form. Generally, form is what people are interested in. That is the danger that should be avoided. Substance is what we should be interested in. Right? So anyway, this is the third category of commodities. Another commodity is happy that there is no name. No name is there, but what is the nature of this? Income is increasing also by 7%. Demand for the commodity is also increasing by 7%. Exactly same proportion, both are increasing, which is good. That means it is unitary elastic. That means what? Elasticity of demand. Which elasticity? Income elasticity of demand is equal to 1. When it is equal to 1, what we call that? Unitary income elasticity. That's it. That is a name. Unitary means unit. 1. That is equal to 1. So when this happens, if the percentage change in the demand and percentage change in the income, both are equal. Both are same. Means numerator denominator equal. When numerator denominator equal, resultant will be naturally 1. Then another thing. Income of the households increases by 5%. Demand for the buttons does not change at all. It does not change at all. Means what? There is no change in demand. 0 in the numerator. 0 divided by anything is what? Anything. That is 0 only. So what is this here? Income elasticity of demand for such kind of commodities like buttons, salt, again like matchboxes. These are nature of them is that just because you have a lot of income, Karodpatis, Mukesh Ambani is not going to buy crores of matchboxes and use them. He's not going to use tons and tons of salt in his food. He'll die. So that problem is, even though the income increases, the demand for such commodities will not have any impact. They don't bother. People don't bother about the consumption of them. That is the nature of such commodities. Examples are those things. So means what? The demand for such commodities does not change at all, even though the income changes, increases, decreases, still the demand does not change. So income elasticity is 0. That means, in other words, we can say the demand for this particular commodity is not responsive to the changes in the income of the people. That's it. That is about various examples and possibilities of income elasticity of demand. Usually, we have to also clarify this. This is one thing, this is what I was also talking about. Usually, you use these words in a different way. Luxury, necessity, inferior. What we use them is not what we really care about it here. We are cared about here economic theory. In economic theory, we use them in a different way. In economic theory, what is a normal commodity? What is a normal commodity? Necessity, you call it. You can call anything, but calling is not important. What does it mean important? What does it mean if it is a normal commodity or a necessity? Income elasticity is greater than 0, positive, but less than 1. When can we call anything as a luxury commodity? If the income elasticity is greater than 1. When can we call a commodity inferior commodity? If the income elasticity is less than 0, which means it is negative. Unitary and 0 are other two extremes. These two are also there, but those are direct things. But majorly the commodities will be in these 3 categories. Either they are normal goods or luxury commodities or inferior commodities. You should be very clear about income elasticity of demand behavior related to all types of goods. Of course, knowledge of income elasticity also is equally important as the knowledge of price elasticity was important earlier. So all things are important for businesses, for everything, including production planning and management, will require proper understanding of income elasticity of demand concepts as well. Accordingly, only the demand can be estimated. See, ultimately, any organization would like to know what is going to be the potential demand for its product. Without knowing what is the potential demand, it cannot estimate or budget the sales. This is what we talked about earlier also. So sales is something which has to be budgeted first. Sales. Once sales are done means estimated, then once sales are estimated, then only the remaining things like production can be estimated. So always we have to see how much sales could be achieved by an organization is the topmost priority for every organization. That's what we call it demand forecasting, which we'll discuss in the same unit. But we have to understand at a broader level, sales estimation or sales forecasting is a very crucial aspect of organization. And how is it possible without knowing the price elasticity of demand relationships, the income elasticity of demand? how the demand is related with the price, how the demand is related to the incomes. Without knowing that, sales cannot be projected. That is why for any organization, understanding the elasticity of demand of its products, if not calculation, at least understanding the tendencies will be definitely important. That is second category of elasticity of demand, that is income elasticity of demand. So far we have discussed about price elasticity of demand and income elasticity of demand. Now let us move on to another point here, that is cross elasticity of demand. Cross elasticity. So cross elasticity of demand means what? Cross itself means what? We are talking about different commodities. So simply speaking, when we say cross elasticity of demand, we are talking about this cross elasticity demand is all about the related goods and related commodities, how they are having a relationship between the price of one commodity, and impact is not on that just commodity, that commodity itself. The impact is there on the other commodity also. And we know this very clearly. What are the related goods? Related goods are what? Related goods are generally two types. One is the substitutes, other one is complementary commodities. So these two types of commodities are called related goods. So when we have related goods, some goods are substitutes and some goods are complementary commodities. The point is, if the price of one commodity is increasing, how the demand for substitute will change, or the demand for complementary commodity will change. That's what is cross demand. So cross demand is about the change in the price of one commodity, but demand is not about that commodity. Demand we are talking about of some other commodities. So simply speaking, the demand for a particular commodity may change due to the changes in the prices of related goods. So the price is changing of related goods, demand is changing for some other goods. So what are those related goods? Could be substitutes or complementary commodities. This type of relationship is called as cross demand. When the price of one commodity increases, the demand for substitute or complementary commodity changes. How it changes is what is called cross demand. That is the concept of it, which we already discussed. There is nothing new here. It was earlier also already discussed. But the question here now is what? That is about the quantification of this relationship. Okay. When we talk about quantification, we are talking about all the other things remaining same. That is always there. When you talk about price, only price changes, all other things will remain same. When you talk about income, only income changes, all other things remain change. When you talk about the cross elasticity, only the price of the related commodity changes, all other things will remain constant. So which means always whenever we are calculating the relationship of one factor with the demand, that factor only changes, all other things remain constant. That logic is always there. But what we are supposed to know here is how the substitute products and complementary commodities behave according to a change in the price of its related commodities. So when you have a substitute, the price of something is increasing and the quantity demanded of something else is changing along with that. Same thing we have discussed earlier. Once again, as an example only, if you take like say coffee and tea as substitutes, again practically they may not be substitutes, but we don't care. As an example, if you take, look at this here, what is happening in case of this graph. These are substitutes, coffee and tea. So when the price of the coffee is increasing, let us say from P to P1. So this is the change that happened from here to here. So what happened to the price of the coffee? Price of the coffee has increased. Are we talking about the demand of coffee? No. If we talk about demand of coffee, that is different. Then definitely the demand of coffee would have been decreasing. But that is not what we are testing. What we are testing is the demand for tea. What happened to the demand for tea? It has increased. So when the price of the coffee increasing, demand for tea is also increasing. That is why they are having a direct relationship. Naturally, when there is a direct relationship, the graph, the line is upwards from left to right. If there is inverse relationship, it would have been downwards from left to right. Since there is a direct relationship, there is that is upwards from left to right. Where is the direct relationship between the price of coffee and quantity demanded of not coffee, quantity demanded of tea? So this product is different, this product is different. What we are looking at this product is the price. What we are looking at this product is quantity demanded. So when the price of the coffee increases, the quantity demanded of tea also increases. Why that happens? Simple logic. When the price of the coffee increases, the demand for coffee first of all decreases. That is the first thing. Both you have to understand. When the price of the coffee increases, demand for coffee decreases. When the demand for coffee decreases, demand for tea increases. So there is an intermittent thing which we don't take into consideration. Directly we look at these two things. But there is an intermittent thing that we should keep in mind. These two things are there. These are related, definitely. The price of coffee and demand for tea, both are directly related. If this is increasing, this is also increasing. That we know. But is it not? Is it happening directly? No, it is happening indirectly. Why is it happening? Because of this it is happening. Price of the coffee increased, demand for coffee decreased first. When the demand for coffee decreased, people shifted from coffee to tea, because of which the demand for tea increased. So this intermittent thing is what is important. That is the logic we should keep in mind. We don't have to give in the answer, but this is what is going to tell why this relationship is existing. That why is important. That why is told by the intermittent, the between logic. What if it is complementary commodities? It is reversed naturally. Now look at this. Price of the pen. So here what happened? Price of the pen increased. See, when the price of the pen increased, or let us say decreased, either way you can do that. If the price of the pen increased, what happened here? The demand for that ink got decreased. So if you take this one, P1 as the first case, this is the point. This is the point here where the price was P1, demand was M1, let us say. The price has been increased from P1 to P. In that case, the quantity demanded of ink has reduced from M1 to M. There is a new point. So what happened here? Reverse relationship. When the price increases, demand decreases. Demand of what? Price of what? Price of one complementary commodity and the demand of another complementary commodity. So what is the nature of these two commodities here we are talking? Ink and pen. That is nature of complementary goods. That's why we are calling them as complementary goods. So complementary goods means those which complement each other. They are not competitors. If one of the products is having more demand, automatically that will increase the demand of other product also. But we are not talking about demand. We are talking about price and demand. Again, one understand the same way. Imagine the price of the pen has increased. When price of the pen has increased, demand for pens is first of all, demand for pens is decreased. When the demand for pens is decreased, naturally the demand for ink also decreased. Once again, the intermittent thing we are not using. Directly we are saying that okay, this is the inverse relationship. Inverse relationship is there, but it is not happening just like that. It is happening because of another phenomenon. Whenever the price of the pen increases, the demand for pens decreases. Because the demand for pens decreased, the demand for ink also decreased. This can be applied to cars and tires, or this can be applied to the printers and cartridges. Any examples can be taken for understanding purposes. In the examples, don't try to think about unnecessary items like, sir, who is using ink pens nowadays? I know that nobody is using ink pens, but this is only an example. So those things are all just for fun. But normally when you take an example, just consider it without attachment to the real name of it. Just think that as this is one product P, this is one product I. That's all. You don't care about ink, pen, all those things. We don't need to really worry about. In your brain, you just think about two products, A product, B product. That's it. So that is once again substance over form which matters. So don't worry too much about form. Coffee and tea are not really substitutes. You know that. That is why we are just talking about an example. So this is just some product called coffee, that is C, let us say. Some product called tea, whatever it is. So we don't care about the real, you can say the name of these products. Mostly what we are interested in the relationship. Any two substitutes will behave like this. If a coffee, tea are substitutes, they will also behave like this. If not, they will not behave like this. So what is the big deal in that? So they will behave like this only if they are substitutes. If they are substitutes, how they will behave? When the price of one increases, the demand for other also increases. Why that happens? Because of this in between. If they are complementary, how they will behave? When the price of one increases, the demand for other decreases. Means they are reverse relationship. So here you can see the graph also. For substitutes, the cross elasticity is positive. For complementary commodities, the cross elasticity is negative. How do we know that? Because the relationship is inverse. As one is increasing, the other is decreasing. So it is negative, means going from left to right downwards. So this is the upward curve, substitutes. This is a downward curve. That is complementary commodities. So this is naturally positive relationship. This is negative relationship. So this is a direct relationship. This is an inverse relationship. So all these things you have to keep in mind technically when we look at the cross elasticity of demand related to substitute products and complementary commodities. Now the question comes, sir, how to calculate the cross elasticity of demand? Simple formula, nothing new here. What we have to use is the same old formula actually. If you remember the original formula of the elasticity of demand, nothing new will come. We have to just change certain things only. Let us remember the original formula of the elasticity of demand. So what does it say? It says delta Q divided by delta P. That was the original formula, right? Delta Q divided by delta P into P divided by Q. That was the original formula for price elasticity of demand. We wanted income elasticity. We replaced P with Y, delta P with delta Y. That's it. That is income elasticity. Now we want cross elasticity. Now understand what is that we are talking about. Here, there are two commodities. Let us say, once again, for example, X and Y. X is one commodity, Y is another commodity. Just for understanding, anything is okay. Reverse also is okay. A and B, sir, I will take. P and Q I will take because already they are P and Q. So don't try to be unnecessarily complicating thing. Let us say X and Y are two different commodities, which are what? Could be substitutes also, could be complementary also, we don't care. But they are related with one another. But always what we are trying to do, we are trying to check the price of one commodity and the quantity of some other commodity. So price of one commodity means it should be any one. So if you say price of X, I want to check. So delta P also will have X, P also will have X. Then Q you will check not for X, Q will check for Y. So delta Q also will have Y, Q also will have Y. Then that's what is cross elasticity. No sir, I want to check Y's price and Q's quantity. No problem. Then P you will have Y, delta P you will have Y, Q will have X, and delta Q and Q will have X. So that's what is the formula here given. So delta Q of X divided by delta P of Y into P of Y divided by Q of X. So simply speaking, what of one commodity Y, whichever that is, Y, X, doesn't matter. One commodity, here example of Y, price of that commodity is being taken here. And what is the impact of that on the quantity demanded of another commodity X is what is taken here. That is what is cross elasticity of demand. Simply speaking, if it is positive, that means it is a substitute. If it is negative, that means it is a complementary good. Simple. If it is positive, that is substitute. If it is negative, it is complementary. That is the cross elasticity of demand. Positive means direct relationship. Negative means inverse relationship. Simple. So this has to be also remembered and understood actually more than just remembered. For substitutes, the cross elasticity will be positive. Positive substitutes. For complementary commodities, the cross elasticity of demand will be negative. So there will be for complementary commodities, that's what is given here, cross elasticity will be negative. That's it. That is the relationship between one price of one commodity and the quantity demanded of another commodity. That's what is related goods and called as cross elasticity of demand. Clear? So that is one point to be noted. But of course, always not necessary that the cross elasticity, if it is negative, they are always complementary. That is a reverse point once again we have to note. If the goods are substitutes, cross elasticity will be positive. If the goods are complementary, the cross elasticity will be negative. That does not mean always wherever there is a negative cross elasticity, automatically that is referring to a complementary commodity. Not necessarily, because sometimes the income effect of the price change, if it is very strong, then also the cross elasticity could be negative. So the negative cross elasticity automatically does not make the goods complementary. That could be because of income effect of price change also. So when we discussed about the price effect, that has two things. One is income effect, other one is substitution effect. So here substitution effect works for what? That is for substitutes. It works for that. So naturally, whenever we say that there is a cross elasticity positive, we can call them as substitutes. No problem in that. There is no problem in calling any commodity with a cross elasticity positive. It can be called as substitute. However, reverse is not true. If the cross elasticity is negative, we cannot call that. Always complementary, not always complementary, not necessary. Just because the cross elasticity is negative, because it could happen due to income effect of the price change also. So if you go back and remember the price effect, which has two aspects, one is income effect, one is substitution effect. So if it is income effect that is affecting more, still the cross elasticity could be negative, but because of substitution effect, definitely always the cross elasticity will be positive. So we have to keep this in mind. For substitutes, the cross elasticity is going to be positive. For complementary commodities, the cross elasticity is going to be negative. That is true. But the negative cross elasticity sometimes could be not just because the goods are complementary, but also because of income effect. That is also another sideline point we need to know. Of course, after each topic, we will say that is important for managers. Everything is important for manager. That is why we are learning in business economics, right? Business economics itself is that. So definitely every concept, price elasticity, income elasticity, cross elasticity, definitely it is important. You need to also look at what products are available in the market as your substitutes and your competitive products, or which are those which are complementary to your products. So how the prices of those commodities is changing, what impact it will have on the demand of your commodity. All these things the business managers definitely will have to have a understanding and look. So they need to be very thorough with the concept of all types of elasticities of demand, be it price, income, or cross, all. So price elasticity of demand, income elasticity of demand, and now we have cross elasticity of demand. Three types of elasticities of demand. We should be able to calculate and we should be able to interpret and apply them in the real life situations if required. Now let us just quickly go through this illustration number 1. This is just for calculations. You have to do these calculations. Look at this. The price of the 1 kg of tea is 30 rupees. So that is original price. So let us call this as P just for understanding. So P is equal to original price, that is 30 rupees. Once you have this, then only you can substitute. Then at this price 5 kgs of tea is demanded. So original quantity is, that is 5 kgs. That is price of tea. Let us put it this way. Price of tea is 30. Quantity of tea demanded is also 5 kgs. 30 is rupees, 5 is kgs. If the price of coffee rises from 25 to 35. So now price of coffee we are talking. Price of coffee. Price of coffee originally how much? 25 rupees. Now it rises from 25 to 35 means what? Means delta P is how much? Delta P. Delta P is how much? Delta P is 10 kgs. So delta P of what? Coffee naturally. So change in the price of coffee is 10 rupees. That is 10 rupees change in the price of coffee. Then the quantity demanded of tea rises from 5 to 8. So now we have delta Q of what? T. Delta Q of T is how much now? That is 3 kgs. From 5 to 8 it has raised, means the delta Q is 3 kgs. So the point is, for cross elasticity what all we need? We need price of a commodity and change in the price of that commodity. We have that. This is what we have. We need quantity of a commodity and the change in the quantity of that commodity. So what is the useless information in this? This is the useless information. That is a point to be noted. Unnecessarily if you use this 30 anywhere, that will be of completely no use. Ultimately the answer will go wrong. So don't use unnecessary information. Identify the relevant information. So price of coffee and quantity demanded of tea is what is in the question. Then you can substitute directly. Anytime you can easily substitute. So what is there in the, what is the formula here? Delta Q by delta P into P by Q. Delta Q is where available. For T it is available. So 3 divided by delta P, for which it is available, for coffee it is available. So 3 divided by 10 into P, original P. Original P is 25. Okay. Divided by Q. Original Q is 5. That's all. So when you have this calculation done, you will have easily the answer finally. So 5 will go here 5 times. So that will go here 2 times. So 3 by 2 means 1.5 is the answer. So 1.5 is what? That is the cross elasticity of demand. Positive or negative? It is positive, because once again you have to understand what is happening here. Price of the coffee has increased from 25 to 35. Quantity demanded of tea also increased from 5 to 8. Both are increase. This also increase, this also increase. So the cross elasticity is positive. So what can we call that? The substitute, they are tea and coffee here in this example are substitute goods. Once again, not necessarily in reality. Examples wise, yes, they are substitute goods. That is cross elasticity of demand. How to calculate? Using the formula delta Q by delta P into P by Q. And point here is the delta P and P are related to one commodity, delta Q and Q are related to another commodity, whatever that commodity may be. Then another illustration can be taken here, that is illustration number 2. Look at this. The price of 1 kg of sugar is 50 rupees. At this price, 10 kgs is demanded. If the price of the tea falls from 30 to 25, consumption of the sugar rises from 10 to 12. Find out the cross price elasticity and comment on its value. Of course, in the main exam, you cannot get this because comment and all is a descriptive thing. But you should know that concept, definitely we should know. So what is the change here? Once again, you have to identify. What is one commodity? One commodity is a tea and another commodity is a sugar. These are two commodities. First of all, that we should identify. What is available data? Available data is very clear. The price of the tea falls from 30 to 25. So price of the tea, originally price was how much? 30. Original price of the tea was 30. Now the delta P change in price, nothing but. Understand this very carefully. Delta P is change what? Fall. Fall means minus 5, not 5. From 30 it has become 25. So delta P is minus 5. So that is for tea. What about sugar? For sugar, original consumption, the quantity, let us call this Q. So quantity originally consumed is 10 and now delta Q changed. It is positive. Why? Because it has increased from 10 to 12. That means 2. So we have all the data here related to computation of cross elasticity. Once again, same. How to compute the cross elasticity? Using this formula and substituting delta Q by delta P into P by Q. Delta Q how much? 2 divided by delta Q by delta P how much? Delta P is minus 5. Same what we have into multiplied with P by Q. P how much? Originally 30. And then Q how much? Originally 10. That's it. We have the cross elasticity. That comes to how much? Minus 1.2. Do the calculations. Minus 1.2. Why? Because out of these 4, 1 is minus. That is enough. The entire answer will be minus 1.2. Since the cross elasticity is negative, what can we call these commodities as? We can call them as complementary commodities. In general, that is the nature of complementary commodities, that their cross elasticity of demand will be negative. Okay, that is about income elasticity of demand and cross elasticity of demand. Very important types of elasticity of demands after the price elasticity of demand is known. So price elasticity of demand is what we already discussed. Income elasticity of demand, what are the possibilities of all that income elasticity of demand, we discussed today. And most importantly, the cross elasticity. Definite questions will come from the cross elasticity. When a substitute will, what kind of cross elasticity a substitute will have, what kind of cross elasticity a complementary commodity will have. Mathematically, it can be just calculated using the formula, and if the answer is positive, it is substitute. If the answer is negative, it is complementary. Like this, any elasticity can be calculated, not just these things. Like for example, you take advertisement elasticity. Advertisement elasticity can also be calculated. What is there? Percentage change in demand divided by percentage change in advertising. So means what? If for example, there is a huge increase in demand, if there is a percentage change in advertising also increasing, usually these two are related directly, usually. So more the advertising, demand also will increase more. In general, that's how it happens. If the percentage change in demand is more than the percentage change in advertising, let us say somebody just increased a advertisement expenditure by 2%, whereas the demand has increased by 10%. Imagine, just like that, if at all for any particular commodity happened like that. If it happened like that, that means there is a huge advertisement elasticity for that particular type of product. So, like any other elasticity of demand, advertisement elasticity of demand also can be understood in the same way, interpreted in the same way. Nothing new here. What is the formula? Percentage change in demand divided by percentage change in the factor. Here, what is the factor? Advertisement expenditure. That's it. That is about percentage change in demand by percentage change in advertisement expenditure. That is what we call advertisement elasticity. No, sir, I want a formula for this. No problem. Same thing. So delta Q divided by whatever we had earlier. Delta, let us call it as A. Delta Q, normally what we take here, by delta P of something or income. So here we call it A, let us call, right, into A by Q. What is A here? A is the change in advertisement expenditure. Q is the change in, Q is original demand. A is advertisement expenditure. Delta A is change in advertisement expenditure. Delta Q is change in demand. So delta Q divided by delta A into Q by A. This is the formula, if at all. Like this, any factor we can create a formula. Ultimately, the formula concept is same. Percentage change in the demand divided by percentage change in that particular factor which is influencing the demand. Here, what is the factor that is influencing? Is the particular organization's spending on advertising. That's what is influencing. How is it influencing? Generally, it will influence positively. If advertisement expenditure increases, demand also increases, and vice versa. However, how strongly it is influenced, that we have to find out by using numbers. We need to have the change in the demand divided by change in the advertisement expenditure multiplied with original advertisement expenditure divided by original demand. That gives us advertisement elasticity of demand. And what does it indicate also is same. Let us say if it is 0, means the advertisement expenditure has no impact on the demand at all. Demand does not respond to advertisement expenditure. That's what 0 means. In other words, there is no impact of advertising on the demand of that product at all. Completely, the product is not having any relationship with advertisement expenditure. What if this elasticity of demand is advertisement expenditure is more than 0 but less than 1? Positive. But what does it mean? The change in demand is less than proportionate. Naturally, less than proportionate to the change in advertisement expenditure. It is increasing. Demand is also changing. Advertisement expenditure is also changing. No problem. Both are increasing also. No problem. But the numerator is lesser than denominator. Then we call that the final answer is less than 1. If it is equal to 1, once again always the same, means the both are changing in same proportion. Which both? Demand also, advertising also. Both are changing in same proportion. If that is happening, then it is equal to 1. It means advertisement expenditure elasticity of demand. If the EA, elasticity of demand of advertisement expenditure, is more than 1, that means this is a product which is very responsive to advertisement. So the demand changes at a higher rate than the change in the advertisement expenditure. So this is what we are talking about. In this particular example, let us say the advertisement expenditure elasticity is 5, 10% by 2%. 5, which is greater than 1, means highly elastic to changes in advertisement expenditure. That's it. That is about elasticity of demand. Different types of elasticity of demand, whatever we discussed so far. Price elasticity, income elasticity, cross elasticity. Just for calculation purposes, one more thing is income elasticity of demand. Sorry, price, income, cross and advertisement expenditure elasticity of demand also we discussed. These are the technical aspects of this chapter. With that we can conclude. These are the things which will come in the examination as questions in general. Demand forecasting is a very generic point. We will definitely discuss that also, but in our overall broader basis. But majorly what technical aspects will be covered in this chapter as far as examination questions are concerned is going to be mostly in relation to the demand theories and elasticity of demand, different types of elasticity of demand and their calculations and their interpretations. This is going to be the core area of examination testing. Right, with that we can conclude this session, and in the next session we'll continue with the demand forecasting techniques and how is it useful for the organizations in a real life scenario. which is more generic in nature than technical. So the technical aspects of this unit number 1 of chapter 2 is done. 99% of the questions that will come from this particular topic will be technical questions only. So for whatever we discussed, that is enough to answer all the examination questions that might be expected from this particular unit, that is demand. With that, we can conclude this topic of demand, and we can move on to the next topic in the next class. Till that time, take care. Bye bye. Thank you very much.